good evening, everyone. Depending on where you are, I know we have people joining us from all around the world. I am Jeff DeCicco. I'm the Managing Director and Global Head of Business Development at Golden Gate Global. We are an EB5 regional center, specifically focusing on development in the San Francisco Bay Area. Throughout our almost 13-year history, we've raised over $700 million through the EB5 program. The purpose of today's webinar is to highlight the economic conditions currently and in the future for the San Francisco Bay Area. Some guests have pre-submitted questions, and hopefully we'll get to them at the end if time allows. But we are delighted to welcome today Jeff Henderson with us. Jeff is the Executive Vice President of CBRE, which is a leader in commercial real estate services and investment. Specifically, Jeff has, I would say, almost encyclopedic knowledge of the San Francisco Bay Area real estate market. Jeff, if you wouldn't mind sharing with the audience a little bit about your history in real estate.
Sure. Thank you for the introduction, Jeff, and thank you to Golden Gate Global for having me. And couldn't be happier to talk about why the Bay Area today, tomorrow, and in the long term. So when I kind of think about where I've been, I'm born and raised in Sunnyvale, California. So my knowledge really comes from being a local, a native son for the last 43 years, 44 if I'm being honest. I've got 18 years experience at CBRE. Before that, I decided to go to law school. It wasn't the right fit, but I took a lot of those skills learned and translated it into investment sales. Since then, I've had the pleasure of working for some startups to acquire property across the Bay Area, some people to help lease it. And then also I've pivoted from commercial into multifamily institutional investment around 2016. And we've done a pretty decent job closing near 3 billion and having, I think, almost about 20,000 units sold, existing and under development. So we've got a good amount of knowledge on both the existing and the development side of the multifamily equation.
Oh, that's very impressive. So we're really lucky to have you join us this morning. Thanks again. I thought we'd start maybe by just asking you to give kind of your broad overall outlook in the Bay Area real estate market, short, medium, long term, just in general, what your thoughts are on the market right now and in the future.
Right. I mean, luckily, we've got a lot of eyes on the Bay Area. We always have. We're consistently ranked one of the top dynamic markets across the US. And a group called Heartland Forward just released a report just about last 2 weeks, once again claiming that the Bay Area ranks #1 and #2 across major economic growth sectors. And those sectors are really some of the most important, we think, for the metrics of why invest in any area. In terms of average annual wages, employment bases, real GDP by location, per capita personal income, share of total employment for firms 5 years and younger, startups, and the shares of employees at those startup firms with bachelor degrees or higher equivalency. Essentially, the San Jose MSA and the San Francisco Oakland MSAs rank highest across both of those nationally. So once again, the marketplace, not just CBRE, is promoting the Bay Area for both near-term and long-term dynamic growth opportunities in the tech sector and beyond.
Yeah, that's great. I mean, when we speak about the Bay Area real estate lately, the last 6 months or so specifically, there's sort of two elephants in the room that it seems like there's a lot of sensational articles out there, a lot of press, some negative, some not, about layoffs that are happening in Silicon Valley. And of course, we all know a lot of that is just adjustments from overhiring during COVID, et cetera. A lot of firms went through extreme expansion during that time. So this is kind of a natural adjustment. What about the layoffs in general? What do you think? Have you seen an impact on the market? And what do you think is likely to happen with that?
Yeah, great question. But to start just briefly, historically, you touched on it very well, that the fact that most people really overlook is from 2019 to 21, the major FANG plus M, or Facebook, Apple, Amazon, Netflix, Google, and Microsoft, those acronym companies, they really accounted for some of the most outsized growth that the nation's ever seen in the tech sector. I mean, Facebook grew 60%, Google 32%, Apple 12%, Salesforce 50%, Microsoft 26%, Amazon grew 100%. And those are 2-year metric levels. So when we see some of the headlines, you're talking roughly approximate values, maybe 95 to 100,000 quote unquote tech layoffs. And most people just say, oh, tech, it's all must be centered in the Bay Area. And the way we've been playing defense to help educate both investors, sellers, and buyers in the Bay Area is to let them know that when you look at the state WARN notices, WARN, those must be provided to all employees at any employer who is letting the state know that they will be experiencing layoffs at that company in the near term or long-term future. And so we peeled those back. It's about 24 to 25,000 layoffs actually affecting the Bay Area. That means there's 75% of those headline layoffs that are some other MSA's problems, and they just haven't even been hitting a ripple effect for a lot of those markets yet. But we see some of those headwinds in markets that people out-migrated from California to really start seeing some significant impacts over the next 2 quarters. So when we look at, yeah, go ahead.
No, I was just going to say, in those WARN notices, I'm not familiar with them. So how far in advance are those usually generated?
An article today that noticed about 4 companies in the Bay Area that had announced layoffs previously. It's about 100 layoffs, and they'll be hitting in May, June, and in July. So they can predict out about 3 to 4 months for the WARN notices to give employees the adequate time to prepare themselves.
Okay. All right. Interesting. And what about, we all read the news stories about the layoffs, but have you seen any specific warning signs that these are going to affect the economy in the Bay Area? Is there anything that kind of jumps out at you that maybe gives you a little bit of pause when you're making your forecasts?
I mean, typically when you come to the multifamily side, you're looking at the fundamentals. Where are we on rent growth, vacancy, supply and demand, and of course, sales volume. So we've definitely seen a slight uptick in vacancy year over year, but that's really following a fundamental US national trend. There are many markets that were the beneficiaries of, roughly, a couple 100,000 Californians that left, let alone about 100, I think almost 200,000 Bay Areans that left. And when I say left, there's quotation marks around that, because really about 33% of the people who left so-called the Bay Area just moved to the super region, Sacramento, Central Valley, Central Coast. And a lot of them came back in 21. And now really what we're most thankful for is some of the best talent that the US has is foreign born. And our immigration has gone up well over 170, I think, percent year over year with HB1 visas coming back into the Bay Area. So that is a very nice offset that we didn't see during the pandemic. And so seeing that rate, I think near double year over year, that's really where we've gotten most of our immigration in the last 20 years. It's really been foreign born, high-tech, biotech, service-oriented employees that have really come in to help push a lot of our local talent.
All right. You mentioned something close to near and dear to our hearts, immigration. I mean, I would tell you just anecdotally for us, the majority of our investors now are H-1Bs who are looking to convert to EB-5, who are in the Bay Area and wish to continue to stay in the Bay Area. And, some of them are nervous about the potential layoffs, but that hasn't dissuaded them from wanting to stay there because they know there's other opportunities there. So if anything, they're worried about sponsorship, not necessarily about wanting to stay or the ability to stay there in the future. So we've seen that anecdotally as well. The other sort of elephant in the room, and I think this is really been sensationalized, and there's a good reason for that, I guess, is the failure of Silicon Valley Bank and as well Signature Bank. I mean, there seems to be an endemic problem in regional banking system that's facing the regional banking system. And we've seen this in Silicon Valley Bank was the first to go under or really face this extreme stress test. Talk to me about that. Do you think that Silicon Valley Bank failure, or even larger regional banks anywhere, that the failure of that bank will have an outsized impact on the Bay Area? Or, do you think it's a countrywide problem? Because a lot of people are pointing to the fact that, Silicon Valley is in trouble because Silicon Valley Bank failed.
Yes, that's another form of defense we've been playing over the last 6 weeks or so since this SVB failure has played out. Now, the way we try to characterize and really, try to compartmentalize the SVB Bank run was that really it's been the default bank for tech startups for the most part over the last, 20 plus years. And when it comes to real estate, at best, you could call it a niche player. And mostly it's been directed towards the affordable housing development sector. So we didn't really see a lot of domestic or foreign investors really going to SVB Bank for commercial real estate backed securities or residential mortgages. So we're really looking at SVB as kind of an isolated scenario. Thankfully, again, the federal regulators moved very quickly to shore up the deposits and ensure the overall stability of the banking system. And I think for the most part, CBRE does not see a large US bank danger sign or a warning sign flashing as a result. I think really it's just more pressure that we've seen on tighter constrained credit markets and where you're getting that leverage in the spreads over LIBOR or as people are pricing SOFR. So it's really just leading to structurally higher costs on capital, but we're not really seeing it stack off against economic growth or people saying, well, that's the number one reason that we're now afraid of investing in the Bay Area. So I think First Republic also was caught in that tailwind with the next week or two after that. And you're not seeing as many deposits flow out anymore these days. So I think there might be some asset management groups or high net worth groups that might pivot to other companies as they take teams. But overall, we still feel that the fundamental banking sector is sound. And CBRE is not predicting any recession in the future led by a banking plunge.
Yeah, I mean, we saw that specifically in EB5. Signature Bank, which also failed, has been really the preferred escrow agent for EB5 regional centers. They did a great job in the past for us, and that failure alarmed a lot of investors, et cetera. But the government stepping in really helped out. And in fact, right now, I'd say Signature is probably the safest bank in the U.S. But of course, in response to that, we did open escrow accounts with other banks. But yeah, I like your analysis. And I think just the name Silicon Valley Bank gave people pause at first with regard to the Bay Area. And it's, from what we've seen, it's been nothing more than that. And I'm a little older than you, but I can remember, in my career, 20 years on Wall Street and now 10 years in EB5, a lot of economic shocks, right? I go back to the Asian contagion and Russia contagion, but specifically was in the heart of the dot-com bust. I was actually a derivatives trader then, so I saw that firsthand. Then the financial crisis of 2008. These sort of super shocks to the economy, and I'm not sure that this qualifies, Silicon Valley Bank or tech layoffs, comes even close to either of those. But historically, if you wouldn't mind just going back a little bit and letting me know, how did the Bay Area respond to these sort of large economic shocks over the last 20 plus years?
I mean, typically the blanket statement is that the boom bust cycles of Silicon Valley lead to higher peaks and lower valleys than other areas, whether that's coastal gateway markets or inbound markets. So we kind of believe that with the job growth here, it's just a constant story of what is the cycle of tech? The cycle of tech in 1997 to 2000 before the crash was, give me a .com and give me a business idea. And even if you don't have revenue, we're going to figure out if we can make a 10x multiple and we're going to spread all these bets around and one of you got to hit. So obviously that plan didn't pan out. So as we get from 01 to 04, we really have a very tight market because from 97 to 2000, we saw rental rates, just soar. You had properties that were leasing at $1 a square foot move to $4 a square foot. You had people that were trying to buy buildings in Santa Clara, California, that had to move all the way down to Morgan Hill and Gilroy to get buildings because prices per square foot dramatically rose as well. From 01 to 04, we have a dramatic resetting of pricing. And then we go from 05 to 06, and we start getting investor sentiment, confidence back into the market. And 6 to 7, again, investment sales hit another peak. Now, you were probably in the market at that time period, so I'm not going to say just put everything on Lehman Brothers and say they're a little over leveraged and they weren't really understanding CLOs and CDOs, but there was obviously some of the smartest guys in the nation running a lot of those funds and accounts. So I think just all it says is everyone has a chance to make a bad misstep, and it's just how do you correct it as you move forward. So the Bay Area, the correction really came from the FANG plus M company starting in about late 2010 through 2013. We saw an unbelievable space race or space grab that led to, by the mid-teens, the FANG plus M companies had acquired either ownership or lease of over 50 million square feet in the overall Bay Area market across office R&D and industrial property types. And they really have not given back a lot of space as we flash forward to 2023. There are rumblings that some more sublease space might be coming on, but you follow the likes of Apple and they continue to gobble up and acquire both ownership and lease perspectives into the 500,000 plus square feet almost every 2 quarters. So we are still seeing that a lot of these companies, they've also learned from their mistakes. But now we've come into where we are today, and it's really being led by HR, divisions. How do we really get butts back in seats? How do we craft remote work policies, return to work policies, and move from 1 to 2 days in the office back to 3 to 4 days, and hopefully back into a 5-day period? And the studies just keep coming out. If you want mentorship, if you want job advancement, it's the face-to-face environment, which I think both yourself, Jeff, and I, like, that's what we were raised in business.
Right.
You conduct transactions, you conduct relationships, you build on everything in your career face-to-face. That's how you build trust, gain admission, and really understand how do you work together with others. So I think a lot of that's being lost on Gen Z, and I think it might take 2 to 3 years for them to realize job advancement, job placement, it really is a word of mouth referral powerful business, as well as just getting your job done. Yeah, the effectiveness and what Google or Apple or tech companies would call chaotic collaboration, turning a corner, knocking over a coffee cup in someone's hand, helping them pick it up, and then ideas to start getting shared. That's really what the Valley was built on in the teens. I think that's what's going to lead to a resurgence in the 20s.
Yeah, I mean, we're seeing in New York. I mean, I'm based in New York, and we're seeing the banking sector already moving back into the office, right? This whole experiment where people were working from home, it's not any good, especially for young employees who are first starting out. I know, speaking personal experience, I had a son who interned at a bank in the summer, and no one was in the office. It was a really difficult experience for them. These kids, that are coming out are, a lot of them really want that face-to-face experience. And I agree, I would say that Wall Street probably would lead the charge in that. It's always been the Bay Area's always been a little more liberalized in terms of, working environments, et cetera. So you would expect Wall Street to move first, but absolutely. I mean, and you can see, you're seeing so that there is still a push for these companies to get people back in the offices.
Yeah, I'm seeing it in real time when I take Tuesday, Wednesday, Thursday going anywhere, that those are the remote work back in office days in the Bay Area and typically in most other MSAs. And my trip from San Jose to San Francisco on a Monday, Friday could be 45 minutes, and it can jump easily to double to an hour and a half on Tuesday, Wednesday, Thursday, as remote work policies continue taking shape and form.
Yeah, and I wonder, do you think not that you're an expert in this, but the prevailing thought is that there'll always be a work from home element, or do you think that really the push is going to be back to a full 5 days?
I think the push to full 5 days could be 24 months out easily.
Okay.
I think the race to attract and retain talent is still trying to provide amenities that offset other employers' opportunities to poach your talent. So being able to be fluid, flexible is still what's really required for a lot of HR groups amongst tech. But it's starting to, I think the Gen Z, as they move into older Gen Z, as the millennials are obviously aging up into their 30s, they're definitely realizing that advancement, progression, career opportunities, they really require face-to-face, and they're gravitating back towards it.
Right, right. Well, I hope you're right. We definitely missed that element. We could just shift gears a little bit. I want to talk about something maybe a little specific to the Bay Area. When you speak about real estate and real estate pricing, it's usually a demand story, right? How badly do people want to live in the area? How badly do they want to live in certain parts of the area, et cetera? Well, I think the Bay Area is a little different in that maybe, of course, there's a demand story, but really there's a larger prevailing supply story. And that might be the main driver, at least from what I've seen, the supply of housing in the Bay Area. So how do you think the Bay Area is situated right now in the short term in terms of the supply out there for housing? And what about needs in the future? Is it likely to be met, or what do those needs look like?
Great question. It's one that really contributes back to the story that Bay Area is one of the highest barriers to entry markets in the overall US. Depending on the municipality that you're trying to get a project through, it could be as short as 3 years. It could be as long as 6.5 to 8 years to get entitlements. And you're going to be doing a lot of horse trading to get through planning, to get through design review board, to justify the restricted regulations for BMR on site, et cetera. But I mean, I think what a lot of people miss is that they keep continually see these headlines of 4,000 units in San Jose, or 6,000 units in San Francisco, 8,000 units in Oakland, Berkeley area are under construction. If we just kind of look at what happened after the GFC, because we did, obviously, for CBRE to give this knowledge to our clients, the Bay Area pipeline in 2008, right before the crash, when you look at what was under construction, what was planned, proposed, and you flash forward to 2010 and 11 and 12, the combined delivery in those 3 years was negative 75% of the overall pipeline that was supposed to have been delivered in those years. So you really saw the credit crunch there, stop kind of construction financing, yield on costs kind of shot up a little bit, and just overall investor sentiment really went back to existing properties and trying to get organic rent growth from the people who were throwing their keys back to the bank. I think we had the Oakland East Bay Metro probably gave back, I think, greater than 7,000 single family keys to banks once the mortgages were a little bit upside down. And that really led to an enormous renter increase in demand, a huge crunch or decrease in vacancy. So now, as we're kind of looking at what just happened in 2022, overall, the Bay Area barely delivered 2% of supply over the existing supply. And if you looked back at January of last year, most people, pundits, or people just looking at the statistics would have said the Bay Area is slated to deliver near 4%. So just in the shock of the last 12 months, 50% of the supply did not hit the Bay Area. It was pushed into 23. 23 plans are pushed into 24 and 25. So once again, CBRE is basically prophesizing that we believe there will be a greater than 70% drop in current supply over the next 3 years for deliveries, which again just means that if you're through that planning process, if you're through that entitlement process, you are so far ahead of the pack that you'll be well placed to have the opportunity to really gain from that really organic growth of demand. And we continue to see demand continue skyrocketing in the next couple of years. Our job growth last year was 5% year over year. 54,000 jobs just in Silicon Valley alone were gained. So we're still seeing that when people realize that you're north of 7% on a 30-year AM mortgage, your down payment needs to be more than 25% right now to justify covenants with your lender, that we still see that the American dream of homeownership is just going through people's fingers again. And again, that's going to benefit existing developers who are already got their plans through. And I just think this year, again, we're predicting barely 1.5%, maybe even might fall to 1% increase of existing inventory over the Bay Area from last year.
Wow. I mean, that actually hits home with us. So the project we have right now is in Oakland. It's in Brooklyn Basin, which is a master plan community. And I want to say it took 10 years to get through permitting alone, right? And the project's probably been contemplated for 15 or 20 years. So same thing. So luckily construction is underway, and one of the buildings on site is almost finished. But we've seen that in terms of concessions, it's a 65-acre plot of land. 32 acres of it are parks. So a tremendous amount of concessions to put things through. The Bay Area has always been a notoriously difficult place to do business in. So, I mean, what I'm hearing from you is that this supply side shortage is not new. This is something that's probably been going on for what? Would you say 20 years or so, or longer?
I'd probably take it back just a little bit further, probably right around the age of my birth. In the late 70s, the state of California enacted regional housing need allocations. They're 8-year allocation cycles. 2023 to 2031 is the commencement of cycle 6. Cycle 6 across the 9-county Bay Area calls for 41,000 new housing units. And Spur has a report that says we're already deficient by over 2 million units. So if you take the past efficiency plus what we're trying to do, you're getting close to 2.5 million units of housing that we truly are deficient on, that we would like to deliver in the next 8 years. And I will take the over on anyone's, I'm sorry, flip that. I'll take the under on anyone's bet. Not that we'll get to 2.4 million, that we'll even get to 400,000. I take the under that we probably won't even deliver 200,000 in the next 8 years. And again, this is the high barriers to entry. This is the cost of construction. This is when the GFC went down, we lost hundreds of thousands of skilled construction labor. And when you talk to most contractors, when you talk about when are costs coming down, what is really escalating in your pro forma budget, it's typically not materials. It's finding that skilled labor that can really help you deliver the project on time.
Wow. Wow, that's interesting. So you're saying that even with aggressive building, there's very little chance that in the next 8 years we're going to catch up to the demand, the supply.
Yes, and even so, when you look at what's happened in cycle 5 in the Bay Area, they're breaking down the number of units overall needed by the average median income. And I think greater than 80% of cycle 5's housing across the Bay Area, 9 counties, were delivered to above moderate or above average income, 120% of AMI and higher. So really that underserved population of 80% AMI, 60% AMI, and especially very low, 35% AMI, these are the employees, the key workers that keep your power on, that actually repave potholes in the road. Like these are the people that need housing the most. And that's where workforce housing was really seen. Probably last year had one of the highest pickups in affordable housing sales volume. We were party to probably $300 million worth of transactions across affordable deals, 100% affordable with multiple restrictions. And again, those workers need more relief. And I just don't think we're going to see it in the near term, unfortunately.
I'm curious, not to put you on the spot, but what is affordable housing in the Bay Area, roughly?
So again, HUD sets every county at different AMI levels based on their locales. And you could be at a family of 4 anywhere from 120 to 145,000 in the Bay Area. And that's just for a single earner. So it's pretty dramatic where these AMIs go to. And even impoverished, you're still in the 60 to sometimes 80,000 annual earning. So this contrasted with the Sun Belt, that could be like 40 to 50,000 for what salaries are in that same AMI range. So again, we have some of the highest annual average salaries, bar none, across the US.
Wow. Wow. So if we shift gears a little bit, we talked about the supply side constraints on the market. The demand side, the demand drivers. Obviously, California's lost population. The Bay Area's lost some population. There's news stories of companies that have left California because of expense or taxes or whatever, and then have been shifting to the Sun Belt, as you mentioned. Have you seen a shift back at all, and maybe companies relocating? And also, are there any other industries that you think that, or either within tech or outside of tech, or any specific industries in tech that you think might be sort of fuel demand in the Bay Area again?
I mean, absolutely. The darling of the last, call it 24 months, has really been the life sciences biotech sector. It's cool off and slowed down a little bit, but we're the #2 biotech market in the US, the #1 on the West Coast. You're looking at 20 million square feet in that South San Francisco area, another 3 million-ish square feet in the Berkeley area, and another couple million square feet in Mission Bay, San Francisco area. And we typically have a pipeline anywhere from about 6 to 7 million square feet. A year ago, that pipeline, people might have said, was 80% pre-leased. Today, maybe it's closer to 50% pre-leased, but those salaries outpace even high tech earners. You can be well over 300,000, if not to 600,000 for a mid-level manager and such in a biotech scenario. When we look at tech, 3 to 5 year employee, you're closer to probably 200 to 400,000. So still, what a salary that many people would be doing cartwheels over if they could attain it. But when we think about demand just in general, a new report was put out last week by Rent Cafe, and it puts San Jose to #1 in terms of renter demand. There's 11 renters looking for every one available unit in Silicon Valley. If we pair that back to East Bay, it's 9-to-1 units. If we pair back to the US, it's 8-to-1 overall. In San Francisco, 6-to-1. Most people would say, I don't think San Francisco has any demand, but the numbers are actually showing no. There is demand across the Bay Area still, regardless of things headlines.
Wow. And that actually touches on maybe the next thing I wanted to talk about, which is probably one of the big things fueling that is mortgage rates have doubled the last year and a half, right? I'm still old enough to remember 8% not being a bad mortgage rate. Of course, we were lucky enough to go through sub 3% for a while. For those people who are lucky enough to buy a home then, now over 6% generally in the US and potentially heading higher. So obviously that's going to have a huge effect on the market. So do you think that's one of the main drivers in the rental market? And what do you think that effect will be longer term as well if rates continue to hover at these rates, these levels, or even go higher potentially?
Yes, it's very difficult. If you've taken one math class, you typically know that you should be renting in the Bay Area if you're not going to stay here for longer than 5 years. Just overall, the U.S. average for gross income apportioned to your household expenses, it should be about 30% of your gross income annually. In the Bay Area, as the rents have come down post-pandemic and are now just getting right back up to equilibrium, I think San Jose is still about 2% above pre-COVID. Oakland's just about 1% below. They've made a really great improvement in the last 12 months. San Francisco dialed back a little bit. They're still about -6%. But again, you had two markets, San Francisco and San Jose, that were in -20, San Jose, near -30% when we get to the trough of pandemic rents. And so battling back quarter over quarter has been great. But again, you're talking about 30%. We're just now in line with rent to incomes overall, every class blended. If we just looked at Class A, you're going to see rent to incomes in the low 20s. And the Silicon Valley would be leading the US nation in Class A affordability right now. Now, when we flip the coin and look at mortgage to income, back to your original premise of interest rates have gone sky high, we basically see that there could be anywhere from a 60 to 80% delta from your rent to income to your mortgage to income in a given submarket across the Bay Area. And in the most recent CBRE study, national study, they actually apportioned a 200% premium to to home ownership premium in the Bay Area versus renting. So you really get into this factor of, are you able to save any money here if you own? And again, it just leads back to a lot of Class A renters. And these are people, when we look at tenant demographic studies, when we do broker opinion of values for Class A buildings, we're still seeing people with 2 commas. And sorry, it's more formal. We're seeing people with multi-million-dollar salaries renting Class A units. And these are numbers that shock us even. Okay, well, we could imagine seeing someone 500 to 800,000 who's just like a temporary person. But when you see someone who's a high-level manager at a hospital, but they're living in Oakland and they're making 2 commas, this is more than quality of life issues. We're really seeing it. You're getting bigger units, you're getting better amenities in the Oakland area, because in San Francisco, you have such a small footprint that the costs are so high, union labor, BMR on site, et cetera, that you're really going to be losing or having a hard time keeping pace with the amenity wars for these Class A tenants. Whereas Oakland really has the opportunity to continue providing roof decks, swimming pools, great fitness areas, remote workspaces inside your units, inside the overall common areas, that you just don't get that opportunity in San Francisco. So we continue to see that there's going to be a lot of groups pressured, whether it's Class C, B, and A renters, to stay renting for longer. And it really boils down to a bottom line of, it's not renter by luxury, you're renting by necessity to basically earn your nest egg to kind of get into home ownership. But that home ownership continues to be pushed out people thinking they could save for 3 to 4 years, it's now at these rates looking like 6+ years just to save for a down payment for many Gen Z millennials.
Yeah, I mean, you're looking at the career arc of some of these, high paid, high demand tech workers where starting salaries might be $150,000 a year and then ratchet up within a few years to $250,000. I mean, what are the prospects of someone like that buying something in the Bay Area?
Well, with where our prices have appreciated since COVID, I mean, people are saying, well, now prices have rolled back anywhere from 2 to 4% in the Bay. It's like, well, great. They went up 30+% in the last 36 months. They got a long way to get back to pre-pandemic numbers. So I think, again, it's really going to be that there's a much less inventory in the overall Bay Area market. I think last count was less than 3 months of supply or inventory was on the market available for sale. And a lot of those homes are kind of stagnated, looking at 2022 values, not seeing a lot of price decreases in certain high-end areas. And we're just seeing that the townhomes, whether it's detached, attached, are taking longer to get through. But more importantly, the public home builders are really on the sidelines. I've never seen more drop deals from public home builders than in the last 6 to 8 months.
Yeah, yeah. And I've seen here, on the East Coast as well, and I'm sure it's similar in the Bay Area, is there's not a lot of inventory of existing home sales, houses for sale, because people are looking at the fact that they're holding out a 2.8% mortgage. And if they go to relocate and buy, they're going to have to pay 6.5%. So it seems like there's very little in the residential markets, at least, here in the New York area. And I'm curious, it's the same thing in the Bay Area. Are you seeing that, like a lack of inventory?
Absolutely, absolutely. And you're seeing it across all the spectrums, from 3 million plus luxury home market all the way down to the starter home market. You're just seeing the ecology of buying up or trading up in homes. It's really hit a stagflation event right now.
Right, right. And you mentioned this before, so I'd just like to drill down a little bit about amenities in the Bay Area, Oakland specifically, that don't exist, inside the city of San Francisco at a price point of under $5 to $10 million. That in-migration from San Francisco city proper out to Oakland and other areas in the Bay, East Bay and South Bay, was a large driver. Obviously, Oakland's gentrified quite a lot over the last 10, 15 years. Are those things still in play right now, or is that still a big driver of demand for other areas in the Bay Area?
I think it's going to be more of a driver for the NorCal and California going forward than it will be for Sunbelt, for sure. I mean, I think that some of the last stats, if we look at what happened in 22, the Bay Area ramped down dramatically from 2021 outbound migration. 2021 was just under 200,000 residents fled the 9-county Bay Area. Last year, it was 122,000. So down greater than a third. And we look at the Bay Area overall, lost about 53,000 residents in 2022. Again, that's less than a third of what happened the year before. And we keep seeing, again, back to the migration, inbound migration, HB1 visas, again, counted for over 170%. So you're seeing that offset. I think greater than 45,000 foreign immigrants came back into the Bay Area. And year over year, the year before, it was barely 20,000. So again, we're seeing this offset of most people, if I just pick on the Silicon Valley, I would say greater than 20% of the people who left the Silicon Valley stayed in the greater Bay Area. And then another third, or 33%, went to what we call the super region or the super mega region, which just stretches out to Central Valley, Stockton, Modesto, Tracy, and then all the way up to Sacramento. So people haven't gone far because they still needed to drive 1 or 2 days back into the office locally.
Right. And then those people that moved out there, I mean, I think there's a decent chance that they'll probably relocate closer, right? After getting a taste of commuting an hour and a half, and when people go back to work 3 to 5 days a week, if that dream where people, can live out in Sacramento and work in San Francisco, once they realize they need to be in the office 4 or 5 days, I imagine that'll probably change.
Yeah, I think there's a couple of factors. You definitely touched on one. What will the remote work policy be or not be, or return to office policy be in the next 12, 24 months? But then we're also talking about, shifts in household formation. Are people really going to say, I'm going to stay in Sacramento for schools when the Bay Area still has plenty of schools ranked 9 and 10 out of 10 for great schools rankings? We're also looking at, when you think about the Bay Area, just in this kind of holistic situation of, we're looking at 12 to 14,000 grads a year from some of the world's leading educational universities, Stanford, Berkeley, Santa Clara, where I went, San Jose State, which almost funnels 15% to Apple and some of the FANGs every year from its graduates. There's still this pressure to be localized if you want to have the opportunities, let alone if you actually want to start your own company. The venture capitalists don't exactly want to take a 2-hour drive to Sacramento or to Stockton Tracy. And in fact, they want you to show up to their offices in Menlo Park, or even in the 2010s, they expanded into, call it South of Market area, China Basin area. And they really set up shop in that Second Street corridor so they could be closer to the Soma tech companies. So people still want, or investors still want to know that their money is well served and is being put to use if it's going into a corporate allocation for a startup or a late stage funding company.
Right. That's great. Great insight. I know we've touched on a lot of this already, but if you wouldn't mind, there have been some recent reports, both by CBRE and others, that have generated forecasts for the rental market in the Bay Area and specifically East Bay, South Bay, et cetera, and how they stack up against other areas of the country. If you wouldn't mind just talking a little bit in terms of what those reports say in terms of 3, 5, 7-year, 10-year outlook for rental markets compared to the rest of the country and overall.
Yes, this has been a bright spot since January, actually, and a lot of people were kind of really scratching their heads. But again, data crunchers smarter than us have produced multiple reports, putting Silicon Valley as number 1, putting Oakland East Bay as number 2, and San Francisco just is still in the top 10 for next 5 years and next 10 years growth. And if we just kind of do a spotlight focus on number 1 and number 2, San Jose, Silicon Valley, and Oakland East Bay, the next 5 years, Silicon Valley is supposed to grow by 5.4% average, 4.4% average to the Oakland East Bay metro. In the next 10 years, both of those metros retain their number 1 and number 2 positions. Silicon Valley looking at a 10-year average of 4.7, and East Bay, Oakland looking at a 10-year average of 4. Again, these put us above the so-called pandemic darlings of Phoenix, Salt Lake City, Austin, Seattle, Boise. So again, a lot of the smile states and a lot of those major MSAs, Atlanta, Nashville, that really welcomed with open arms, a lot of outbounds, California migration, took in a lot of tech workers. Well, tech kind of came back and said, guess what? Salary by location. So even if you're in San Diego, that's an 18% deduct from Bay Area. So if you want to take a look at a deduct in Atlanta or Nashville, you're in 30 plus deduct. So if you want that income, you're coming back in, and that's where we see a lot of these inbound numbers coming. And CBRE, obviously, not to be outdone, we're also looking at, with where we see things going, we're looking at least 3% over the next 5 years in Silicon Valley. Many people would call that conservative pre-pandemic, but there's a lot of investors right now simply underwriting 0 rent growth in multiple MSAs because they're seeing rollbacks of negative. So I think the earliest report we've seen for year over year Silicon Valley was over 8% rent growth, only down by 100 basis points from Q4 when it was 9.1% year over year rent growth. So we're still seeing rent growth maintaining its elevated parameters across other darlings of the pandemic era. And we seem to be coming back into our own as more people keep coming back for opportunity.
Wow, that's really that's really insightful. I appreciate it. Yeah, I mean, there seems to be a lot of optimism around it, despite what you see, the sensational headlines, et cetera. I've seen things, is San Francisco gone? Will San Francisco take California with it? It doesn't seem to me that the the baseline numbers are there to support any of that. It just seems like headline grabbing.
Agree.
Clickbait, as the kids would call it, clickbait. Great. I really appreciate it. What I'd like to do now is just maybe touch on a couple of questions we have specifically from our audience. They gave us these questions before, and we probably covered most of this, but I just want to address it specifically anyway. And to those that are watching, just know that this will be available. We're recording this, so please email us. You have our contact information if you'd like a copy of this. And then if you have any specific questions, you can direct them to us, and Jeffrey or I, one of the Jeffs, will answer. Hopefully the other Jeff, who obviously has a lot more knowledge about this area of the country than I do. But the questions are, and again, I think we covered this, but just to go into this one specifically from a potential or an investor with us, EB5 investments by their nature are generally 5 to 7 years. So what our investors care about is, what is this project going to look like 5 to 7 years from now? What is the market going to look like at that point? So what do you say general growth in real estate in the Bay Area in the next 5 to 7 years? You had mentioned some numbers, but you guys are forecasting, you said 3+% in terms of rent pricing. Is that what you've said?
Right. I mean, overall, we're basically saying that, there is a difference in a dispersion between urban and suburban growth. There's definitely, we believe, outpaced suburban growth. But when we look at a 5-year cash adjusted gross returns across the Bay Area, the nation is only looking at 2.7%, the way that CBRE is tracking. So a 5-year CAGR of 2.7% versus San Francisco at a 2.5, so a little bit below, San Jose near 3, Oakland a little bit above 3. So we're still seeing that going forward with this severe imbalance of jobs to housing, we typically carry Bay Area blanket of 6 jobs for every 1 multifamily unit available. And then I mentioned those stats earlier from Rent Cafe saying 11 to 1, 8 to 1, 6 to 1 across the Bay Area, respectively, San Jose, Oakland, and San Francisco. So again, we see that the demand is going to continue pushing rent growth over the next 5 years, quite beyond what we believe to be kind of a 2% thumb in the air for most institutions, to be slightly conservative. So we're still very bullish on the Bay Area.
Yeah, great. And this question, again, something similar, but someone wants to know, will the demand for rentals go down in the short to medium term, specifically because of the job losses? So is there going to be sort of a dip in the next few months, maybe to a year? Do you guys see that happening, or in terms of the rental market?
Yeah, I mean, we've definitely projected that absorption will be quite tepid this year and a little bit slower. We think that there may be some concession hopping in certain oversupplied markets for the next 2 quarters. But again, we're still seeing that the inbound demand and is one caused by the inability to afford a mortgage. Like that is not going to subside, because we're not predicting a U-turn or a decrease from Jerome or the Fed until early 24, if not even worst case, mid 24. Right. So most of our investors that we're talking to are saying higher rates for longer. And so if your mortgage isn't going to get any better, or the opportunity to get financing any better for a single family purchase, you must rent for longer to build up that war chest for a down payment, or just hope you're going to gain an IPO windfall. And IPOs, I think, are going to be a little thin to non-existent for the next 2 quarters as well. So I think a lot of people are going to be delaying home purchase, maybe even delaying household formation, and again, renting for much longer.
Yeah, I've been around long enough in Wall Street to see that things almost always overshoot. So this idea that we're going to hover at 6% interest rates, mortgage rates, and then slowly go back down, I wish it was true, but I think we're probably more likely to see it jump to 6 to 6.5, 7, even beyond, before we get some relief, especially in the 1 to 2 year range. It always seems like things have a way of going to extremes before they come back to the median. Last one, and again, I think we've answered this, but the Bay Area rental market compared to the rest of the state or country. Let's look at it maybe in terms of the strength of the overall market right now, because you've talked a lot about the forecast, maybe about just the strength of the overall market right now, and let's say in 3 years.
Well, the strength of the overall fundamentals right now is as sound as we've seen them, probably since 2017 to 18. So we're not in the frothiness of 2019. We don't think we're going to see the heights we reached for investment sales volume. The last 2 years were the two highest sales volume years for multifamily on record, going back 40 years of data.
Wow.
So you kind of climb into this almost 200 billion territory nationwide. And so many negative pundits are saying it could be as low as 50% of that this year. It could be somewhere closer to 150 million or 25% off of that. So we're definitely seeing that there's going to be a slowing in sales volume as more landlords are going, wait a second, I realize now I should have sold 12 months ago. So there's going to be a pent up demand for investment sales going forward, which we think is going to somewhat offset cap rate expansion. There's still certain select submarkets that really shouldn't have the so-called blanket 5% going in cap rate that many investors put their thumb up across coast to coast. There have to be winners and losers, whether that's tech sectors, product design, or real estate submarkets, and asset classes. Like we definitely see that, most people want to get Class A for a much higher discount to replacement cost, and that's getting dinged the most. Whereas Class C, which has some of the most durable NOIs in the Bay Area right now, because of no one can really trade up or out of that space because they're really paycheck constrained. That occupancy is going to be hovering well over 97% in a lot of the Class C functional buildings. Class B isn't too far off. It's still going to be in the mid 90s. And we look at Class A, it's barely sub mid 90s, like in a 93.5 to 94%. So again, the fundamentals that we see playing out are still very sound for landlords. For the renters, if they're looking for concession hopping, yeah, the CBDs are probably where you're going to see that opportunity. And I think that window of opportunity will be closing within the next 12 to 24 months. As I see the supply pipeline dropping off in a lot of these oversupplied markets. And I think that that's going to lead to a lot of resiliency in property management firms and on-site leasing managers being able to push renewals and lease trade out numbers much higher than we've seen in the last 12 months.
Right. So you're looking at in the short term, people being competitive for renters, giving concessions, meaning discounts or on initially when they're moving in, but then as it recovers, if these are one year leases in general, then being able to move the rates back up pretty significantly, like moving out.
Absolutely correct.
Right. Great. Well, I think we've gone over our allotted time, but this was fantastic. I can't thank you enough for joining us today. And again, everyone, any questions, please email us or if you'd like a copy of this. And I really hope we can do this again sometime soon. And Jeff, thank you so much for speaking to the leadership.
Yeah, thank you for having me.